Hello, my name is David Miller. I'm speaking to you in early January 2022, the new year. I am the co-manager with my colleague Carl Williamson of Nexus Global Solutions Portfolio and Nexus Global Dynamic. Well, December was a mixed month, but ended up well. And I'm pleased to report that both portfolios made further progress. Solutions up by about 0.5%, Dynamic, the all-equity portfolio, up by just over 2%. And that brings the year-to-date returns for Solutions to 7.5% and Dynamic nearly 14%. Both excellent returns in absolute numbers, but also relative to inflation. So investors are better off not only in nominal terms, those numbers show that, but also relative to inflation, which, as we know, is on the rise at the moment, but ahead of both measures, which is good to see, good to report. So what's been behind the move higher for markets? The headlines remain pretty awful most of the time, and yet somehow that doesn't seem to matter to investment markets. Why is that? Well, predominantly, investment markets are driven by growth, economic growth. And last year, 2021, was the best year for 40 years. Admittedly, after the crater of 2020, but very good to see. That made a lot of difference last year. And also, governments and central banks have continued to support investment markets with low interest rates and spending. Both very much needed in 2020, perhaps less so last year, but they've continued to provide that support, and investors have been able to benefit from it. The detail does matter. Companies we try to select have proved themselves to be adaptable and resilient throughout this period, and that's really important. Dynamic is the all-equity portfolio, global equities. We can look anywhere we like in the world for good value. Solutions is constructed to provide a smoother ride. Still over 50% invested in equities for growth, but also investments in fixed interest, infrastructure, property, and alternatives such as hedge funds. But the shares in both portfolios are the same, just slightly different amounts in relation to the total. And interestingly, and quite surprisingly, in December, there was a change of leadership. The technology companies that have really helped us over the last couple of years, and those that have taken advantage of pandemic changes like Amazon, but Adobe, the other FANGs, were at the bottom of the pile. And at the top, a surprising list perhaps, Marriott Hotels, Coca-Cola, Airbus. It just shows the benefits of diversification and balancing, not just reward, but also risk. That rotation between sectors is likely to continue, but both portfolios are positioned to take advantage of that. We're invested in liquid investments. We can change strategy as necessary. So let's look forward. Equity markets, I think, are still attractive. There are, of course, uncertainties, but embedded in markets at the moment are some proper assumptions which have every chance of coming true. One is that the interest rates will rise in 2022, but only by fractions. That's now accepted and in the price. The second thing is that although economic growth won't be as good as last year, difficult to beat that, it will be better than average, and that's very helpful. We're making some assumptions about geopolitical risk, that Russian maneuvers will remain bluff, not action. Watch this space. I'm telling you what the markets are assuming, and which I think is a reasonable place to start from. And finally, that Omicron will subside. The peak is approaching, and it will follow the path of the other variants over the last couple of years. So that's where we are on that. And if I was going to be more optimistic, or even more optimistic, because I think those factors are going to be very helpful. We're looking at the company results season, which is about to start, and I expect we will see good earnings numbers announced by many companies that we're invested in, and better than expectations, I hope. That's positive. And the final thing that may help us in the next month or so is inflation and energy prices. Both have been on the rise, and they are linked over the last 12 months. Signs perhaps of a plateau approaching. Year-on-year comparisons will get easier. The headline number might start to fall away, and that will take the pressure off central banks to increase interest rates. All reasons, I think, to be optimistic about this year ahead. So finally, I'd like to raise something else. I have been the manager of solutions since the start in the middle of 2013, and co-manager of Dynamics since we launched that portfolio a year later. But I've now decided that after a 41-year career in the city, in finance and investment, that it's time to retire. And so this will be my last report. Next month, my colleague, Carl Williamson, who I have worked with since 2008, and who has been fully involved in the management of both portfolios over the years, will be taking charge and reporting to you. So in signing off, may I wish you all the very best, stay well, and keep investing. Thank you.